and you're watching CNBC TV18.
Hello and welcome to the CNBC TV18 special. I'm Shireen Bhan, and let's give you the latest data in terms of what is happening as far as the COVID situation is concerned. Now, as of today, what we have seen is that the daily COVID case count is below the 2 lakh mark, dropping to the lowest level since the 14th of April. Active cases are lower by over 76,000 in the last 24 hours, with recoveries above 2.5 lakh. Deaths remain below the 4,000 mark for the second day. With some states having shown a consistent declining trend, relaxations in COVID restrictions is on the cards. In Delhi, the Chief Minister Arvind Kejriwal has announced that the capital will gradually begin lifting COVID restrictions from Monday. He did, however, add that restrictions will be reimposed if the rate of infections increases again. In Maharashtra, the government has said curbs won't be lifted fully, but the state is looking at some further relaxations after the 1st of June. Madhya Pradesh has also announced a gradual unlocking of restrictions from the 1st of June. In some states, though, restrictions have been extended. In West Bengal, for example, COVID curbs have been extended till the 15th of June. Separately, sectors that have been severely impacted by the COVID second wave are likely to receive help from the government. We learned that the Finance Ministry has started work on a second stimulus, and consultations with impacted sectors like travel, tourism and hotels are likely to happen soon. They are the possible beneficiaries in this round. Also, the GST Council meeting is currently underway. We learned that Sikkim's proposal to levy a COVID cess on the pharmaceutical and power sector for 2 years has been discussed. A group of ministers will examine the proposal and submit recommendations in 2 weeks. Other states like Arunachal, Meghalaya and Goa may also propose a similar cess. In fact, we are also given to understand that the Fitment Committee's recommendations of a 5% rate on COVID-related products like vaccines, etc., may be the decision of the GST Council, as opposed to the zero rating that was being asked for by the finance ministers of West Bengal, Tamil Nadu and some other states as well. But we are, of course, waiting the official confirmation from the GST Council. To talk to us about the road ahead, joining us here on the program, Rashesh Shah, the chairman of Edelweiss Group. Also with us, Vineet Agarwal, managing director at TCI. He's also the president of ASSOCHAM. Also with me, Ashok Mohanani, president of the National Real Estate Development Council in Maharashtra. And with us, GST tax expert Rohan Shah. Gentlemen, appreciate you joining us here on the program. Rashesh, let me start by asking you, we are on the cusp of the 1st of June, but it looks very unlikely that any state is going to go in for a full-fledged reopening. As we've heard from Delhi and Maharashtra, restrictions are likely to continue, albeit some easing is likely. Now, what does that mean in terms of where we stand for recovery? And more importantly, what does that then set up in terms of the need for fiscal support from the government?
Absolutely. I think you are correct that, when we open up also it's going to be gradual. In COVID now, a lot of people use these terms called hammer and dance. Hammer is when you impose a strict lockdown like what we did 1 year ago. And then there is dance, which is slow opening, slow closing, depending on how things are panning out. I think we are now in a dance phase almost in all states in the country. So we should expect that we'll open up. Then if there is a spike, then there'll be a little bit more restrictions, and businesses should prepare for that. I think it's very important that we in the business community get ready for another 5 or 6 months of this kind of uncertainty and some opening, some restrictions going all the time. We obviously have to make sure our employees are taken care of. I think all corporates, all companies should make sure the employees get the jabs and get vaccinated and taken care of. It will, I think, be another 3-4 months because we are fully normal. I think the full normalcy maybe by October, by which time a large part of India hopefully would have got at least the first dose done. And we should be prepared for that. I think it will have an economic impact. I think May is turning out to be a much slower month than even April was. April was also slow, but when we look at data, when we look at a lot of clients, May is going to be slow. So I think the first quarter expectation should be muted. Even second quarter will not be full-fledged comeback. Only after October, we should expect things to come back to normalcy.
Since you're saying that you anticipate only by October some degree of normalization or full-scale normalization, in terms of fiscal support as well as support from the Reserve Bank, what are you now factoring in? We've already seen the Reserve Bank do pretty much the heavy lifting. I was having a conversation with Uday Kotak. His view is that, look, there shouldn't be back-to-back forbearance that the RBI provides. What needs to be done at this point in time is for the government to do the heavy lifting with fiscal support. In fact, he's of the view that there should be direct cash transfers to the bottom of the pyramid. Now, what is industry working with in terms of stimulus, and more importantly, what's the realistic expectation on that front?
Absolutely. I think, as you correctly said, there is RBI-related monetary intervention and government-related fiscal intervention. We have seen by experience that any monetary intervention is immediately required, but it helps only the banks and the formal sector, which is what has happened in the last 1 year. As you have seen, the larger companies have become stronger because they are able to access the formal finance. The money flows to them. So when RBI loosens up the monetary policy, money goes to banks, it goes to the highly rated companies, the large corporates, maybe the top 1,000 companies in India. However, the fiscal benefit, when Government of India intervenes, it goes to the have-nots. So I always feel that the monetary policy is for the haves and the fiscal policy is for the have-nots. I think the have-nots, because we have seen a lot of individuals, SMEs, they've used up their pension fund, they've borrowed against the pension. You've seen data of borrowing against EPFO. We're seeing it in insurance. People are borrowing against their insurance policies. So their reserves, their cushions are all depleted because this has gone on for 1 year. And I think government, whether it's direct cash transfer, direct support to smaller enterprises, smaller borrowers, to microfinance companies, we are seeing rural the distress is fairly high. I think government will have to intervene because there is no intervention, no tools RBI has which can reach that lower strata of the society. Only government can do that. And hence, I think today evening when the finance minister comes out, I am hoping that there'll be some things which either puts cash in the hands of people, or there is a direct support for the lower strata, the smaller, the informal sector, the MSMEs and all of them.
Yeah, Rashesh, let me just dampen the expectations on that front. Today's press briefing by the finance minister is to do with the GST Council meeting, which is currently underway. Our information is that fiscal stimulus relief measures, that is still 2 or 3 weeks away, and that has not been finalized as of now. But let me take that point across to Vineet Agarwal. Vineet, let's just build on what Rashesh was telling us, that at least for the next 3 to 4 or perhaps 5 to 6 months, things are going to be difficult, especially because what we've seen happen this time around is a deep rural distress. What is the feedback that you're getting from ASSOCHAM in terms of how severe the pain is, which are the pockets that are most feeling the pain at this point in time, and what is the priority that you expect the government to focus on when we talk about relief?
Thanks, Shireen. And yes, building on Rashesh's point, I think clearly it's the MSMEs that is really, really struggling. Of course, the contact sectors in the services from hospitality, tourism, restaurants, etc., are really, really suffering big time. But if we take the MSMEs in general and take the micro enterprises, micro, small, medium, so take the micro enterprises, the small shopkeepers, the street vendors, again, until we do not get them some direct benefit transfer, as well as provide them some kind of working capital loans, they are really going to fail, and many of them are looking to do that. Then we move to the next level. If there are enterprises who are now support, or they do job orders for the larger enterprises, the smaller and the medium enterprises, they need working capital loan. They need maybe increase the working capital limit by 20% and give them without any additional collateral, for example, or reclassify the NPAs. So I think one is a direct impact that is very critical to these sectors. The second is, of course, somehow we need to increase capacity expansion in the country, which is kick off an investment cycle. And that investment cycle cannot be kicked off by anyone right now other than the government. Because as we know that the capacity utilization in the country is in the mid 60s. So no private company is going to start expanding capacity. Government has to front load the investment, and that has to possibly go clearly into infrastructure. And if it goes into infrastructure related to healthcare, that's even better. But old projects need to be kick-started, and they will help us in ensuring that there is some amount of supply side constraints are met. And the third is the demand creation.
Yeah.
So demand creation, all individuals that I talk to and I've heard, they've spent all their money into healthcare or are repaying debts. They're not really doing any kind of consumption link or any discretionary expenditure. I think for that to kick off, there needs to be some other fiscal measures that need to be put in place.
Yes, that is a point that many have made, that discretionary spending has taken a brutal hit on account of the out-of-pocket spending on healthcare. But, since we talked about the GST Council meeting and the expectations there, let me bring Rohan Shah into the conversation. Mr. Shah, the meeting is still underway. What we're given to understand is that, a state like Sikkim has proposed COVID cess, temporary COVID cess on sectors like power and pharmaceutical. This is similar to what we saw Kerala propose to deal with the floods. We're given to understand that states like Goa may in fact support this, and now a group of ministers is going to review this proposal and come back with its recommendations in the next 2 weeks. But I would imagine that this is likely to go through. What do you believe this is going to do now in terms of the overall GST structure?
I think the Kerala situation and the current proposal from Sikkim, both are in the context of emergencies of a massive dimension, and really what you could sort of attribute to forces of nature. From that perspective, I think this is the need of the hour. There is far greater spending that states and the center will require to make on healthcare and healthcare infrastructure. And given the dependence on revenue, it's only logical that you will try and find other avenues. So I personally would not be surprised if the Sikkim proposal not only receives support, but also sort of sees a recurrence in terms of other states wanting to come through with this. And relevant to today's meeting, I do believe that the most urgent set of issues they have is tax measures in relation to anything which is required either in the detection or the treatment of COVID. And from that perspective, again, I cannot believe that there will be divergence. And whatever is being spoken of as a challenge is easily addressable by having a very, very low tax rate on the output, and then providing for a refund of the remainder of the tax.
Since we're talking about relief for COVID-related items, states like West Bengal, Tamil Nadu have proposed that because the primary purchases of COVID-19 vaccines as well as drugs like remdesivir, tocilizumab, etc., to just give examples, are being done by the state governments, there should be for a temporary period a zero rate of GST. This will ensure that the cost of these essential items is reduced significantly without the suppliers having to absorb any reversal of input tax credit. Now, our understanding is that the Fitment Committee is of the view that there should be a 5% rate, not a zero rate. We're given to understand that perhaps not by unanimity, but the GST Council is likely to go along with the decision of the Fitment Committee. We're of course still awaiting a formal communication from the government on this. But what do you make of the state's proposal, the state's demands versus the Fitment Committee's recommendation?
The situation quite clearly is that we want to achieve a optimal balance of the tax, which means optimal tax and also availability of credit of whatever are the relevant inputs. A quite easy way to sort of do that without fencing on the issue between state and center is you could even have on the output a tax rate of, for example, 0.1%. That is then a levy, and because there is a levy, you will get the credit. Now, once you get the credit, there is a contemplation under the Act, Section 54, that the surplus credit can easily be taken as a refund. Now, to the extent that, we might see some technical issues or even legislative issues, given that you have the collective will of the center and the states at the GST Council even if it required either procedural change or legislative change, that is not hard to achieve. So while I think, people can debate on the mechanics, I think the path is pretty clear. Have a very low rate, even sub 5%, as I said, 0.1%, and create a mechanism for credit on the inputs, the net impact of which is the lowest possible tax burden while still maintaining the ability to input. And you will deliver what you want to deliver into the healthcare system at the most optimal basis.
Right. Mr. Mohani, let me step away from GST for just a second and talk to you about what we're seeing happen as far as the real estate sector is concerned. Delhi, for instance, today has announced that from the 1st, they will ease restrictions for construction activity as well as for factories. Other restrictions will be eased over time. There will be a weekly review. But what's the picture state-wise at this point in time in terms of just construction activity, the real estate sector? Because this is, of course, a key multiplier. Mr. Mohani, can you hear me?
Yeah. Sorry, Shireen. Yeah. So you see, as far as
go ahead.
Maharashtra is concerned, okay, we have working very hard to get our labor vaccinated, and we have been partially successful, because the stock of the vaccination is not that great right now. But all over pan India, I would say that about 30 to 40% labor has already migrated, and we need to kind of restrict and curb that migration further by supporting the labor through vaccination, through all the facilities that we've been already giving in the first lockdown. So we were prepared during first lockdown how to kind of get back to the revival stage. So we are pretty much there. But we need the support of the central as well as state government to get our labor and our entire team vaccinated, to give them that confidence of being able to work. And I see, at least residential sector, Shireen, definitely doing well in the near future. We have done extremely well post September 2020 when Maharashtra government had reduced the stamp duty by 3%. And we at Meritco, our members, contributed the entire stamp duty, and we have promised Aditya Thackerayji that we will contribute our part of it, and we will not charge any stamp duty to our buyers. And this saw a great revival. We had about year-on-year increase about 150% of the sales, which were compared to the October-December quarter of 2020 versus 2019. So there is a revival, but then this second lockdown did take a toll on us. We see that the festival season is not that great, but I'm very confident that this will pick up once we have the labor has the confidence of being safe where they're working.
Yes, that is crucial, as you point out. But Rashesh, I want to come back to you and just pick up on what we heard from the Reserve Bank in its annual report, which it just put out a few days ago. And on the issue of asset quality of banks, the RBI basically said that it will have to be monitored very closely, but at the same time did say that banks are much better positioned were in being able to manage their balance sheet because they've got higher capital. Many banks had gone out and raised capital, and that the stress tests indicate that banks have sufficient capital to even deal with a severe stress scenario. Would it be fair to assume this as far as NBFCs are concerned as well? And what's the expectation on the stress in the financial sector going forward, given the adversities that we're faced with today?
Absolutely. I think what happened is last year, the first wave, most of the NBFCs and banks estimated the stress impact on that, the impairment impact on that, and started providing and raising money. And now, on an average, most banks and NBFCs have provided more than what the impact is going to be. So one is, I think, on the equity side, as you correctly said, everybody has raised a lot of money. The capital adequacy for all NBFCs, all banks is higher now than what it was a year ago. So there is a lot more equity on their balance sheet that is there. Plus the provisioning that most banks have done, because even though there was a moratorium given by the Supreme Court. Most of the banks and NBFCs continued to provide, assuming the moratorium will end. So I think there is a fair amount of provisioning and a fair amount of equity out there. And as we all seeing that now the cases are coming down, so there is a downward curve on the economic impact of COVID. And as I said, it might go up and down, but the severity of what we saw a year ago and the impact that the banks and all have taken, this will be very easily absorbed. And we should remember, interest rates are low. Reserve Bank has been pumping a lot of money. That is also benefiting the banks a lot. And Indian banks over the last 5 years have cleaned up a lot of NPA. We had almost about 13 to 14 lakh crores of NPA. A large part of them have been provided for, have been cleaned up through IBC and all. So most of the heavy lifting has been done. And COVID last year, wave one, was the real stress test on that. And I think currently, by most of the assumptions you make, I think it's fairly well provided for. I think the main cause to worry will be growth. I think credit growth is still not coming back. So when we talk about liquidity, there is a lot of liquidity in the system, but that liquidity is not getting translated into credit growth, especially credit growth for MSMEs. And now we are seeing even gold loan companies and microfinance companies have slowed down. So real delivery of credit in the hands of the smaller firms and all that is still severely restricted. And we have had 5 to 6% credit growth for now almost last 2 years in a row. And the economic revival and the real growth will not come back until we cross at least 10-12% credit growth for the economy as a whole. So I think what I would worry about is not asset quality and stress, but I would truly worry about growth and credit growth in the economy.
Yes, you're making a valid point there. But Vineet, I want to come back to you because, you talked about the need for the government to actually front load spending to try and get the economy moving. But that's been the case through the last several years now. I mean, private sector investment has lagged quite significantly. So what's the sense that you're getting in light of all of these PLI schemes and everything else that was announced by the government before the second wave hit us? Do you believe that we're likely to see any fresh capacity being set up, any fresh investments being made, or is the mood across India Inc. at this point in time, from what you can gauge from the ASSOCHAM membership, largely wait and watch?
Well, certainly I think the impact right now is unprecedented because we did not expect the second wave. The impact is also right now, it's coming in phases. As you are seeing that there are states that are coming out of lockdown. So there's a lot of uncertainty that is still there in the marketplace. And clearly, as we've talked about, demand is getting hit. So you're absolutely right. There is a certain amount of hesitancy in terms of new investment to come in. I think what's going to clearly happen is once we start seeing some amount of revival post the vaccination, and I think this will possibly start in August, September more because before the festival season, inventory tends to start building up and hence production also starts. So people are going to look for jobs. Clearly, that's going to be a big issue, which means that there will be pressure at some point that we have to create jobs through the government infrastructure development, etc. And that will help certainly the private sector to scale up as well. I think we saw some of that happening. It did slow down a bit, but I think given the fact that we are going to come out of this, and I'm very, very positive that we will come out of this in a better shape, and we should be able to use this as an opportunity to really springboard into the next cycle of investment. And clearly that is very obvious with the PLI schemes, the Atmanirbhar. I mean, look at the impact that the schemes have had on production, domestic production of electronics. It's just had a massive impact. Similarly, I think the other schemes will also start creating impact, not just for the domestic markets, but also for the export market. So yes, it is a little bit of a wait and watch right now. But as Rashesh also said, the credit velocity, once it starts picking up, we should definitely see some traction with the private investments as well.
Very quickly, Vineet, since we do have you, I just want to understand from you, what are you seeing on the freight side? Since you have your pulse on what's happening across transportation, across supply chains, what is that picture looking like? It managed to hold up, even through the fairly severe period of the second wave. What's the situation currently on the ground?
Shireen, fortunately, this time around, supply chains have not been disrupted. So that's a very good point. There are the truck drivers, etc., have not left their trucks, etc., and supply chains are still active. Certain factories have been shut, as we've heard, because there are cases in their factories and they had to shut. But some of these factories are restarting. Certain states have been a little bit more badly hit. For example, Maharashtra, Tamil Nadu, etc. But overall, it is relatively okay. This is also typically a season when things start to come down a bit. It's the post-March and as well as the monsoon season. But agri starts picking up now. Agri freight starts picking up, and we've seen a good agriculture production. So this should also start benefiting freight as well. So overall, supply chains are still intact right now.
Okay, that's good to hear. Mr. Shah, let me end then by asking you, some of the other items on the agenda of the GST Council, for instance, is delay the return filing due dates, etc., on account of what's happening with COVID. And I'm given to understand, I keep caveating this, we're still waiting for the official announcement, but we're given to understand that those extensions are likely to come through. You would believe that that's the right thing to do?
Yeah, I think absolutely the right thing to do. And, CBDT has already come through with series of relaxations. We're also seeing courts in general, accommodating all businesses in relation to procedural requirements in terms of, limitations on filings. I think it's only fair that it should sort of, go through and these additional periods should be allowed. I mean, anything that we can do to ease the life of the businessman who's facing life and livelihood issues, I think is very necessary and will happen.
Right. Gentlemen, we will have to leave it here on this special edition of the Business Sentimeter. Thanks very much for joining us here on CNBC TV18. We'll pick up on this conversation, as we get more information and more clarity. But for this evening, thanks very much for joining us. We'll take a break. There's a lot more coming up. Don't go anywhere. We're back in a moment.